Well, it must be said that Mr. Market is not a particularly happy bunny this morning. Global equities working on a fourth straight day of losses, and that comes after a rather dismal day on Wall Street yesterday, which saw the S&P 500 close beneath the 50-day moving average for the first time since all the way back in April, which had been the second longest run north of that key momentum gauge for, at least 25 years, as far back as my data goes. In terms of catalysts behind the move, of course, we've seen a bit of waning enthusiasm around the AI frenzy in recent sessions, and that wasn't helped yesterday by Amazon's $15 billion bond sale, which fueled further concern that the AI boom is increasingly going to be financed potentially by debt as opposed to by free cash flow. And we've also got market participants potentially looking to de-risk ahead of all-important earnings from Nvidia, which come after the close tomorrow. Chris Weston's got a good video previewing that on our channel. And then, of course, the September US labor market report, which comes out on Thursday. So participants potentially just squaring up their positions as we move into that spell of big event risk over the next 24 to 48 hours. In terms of the super short term, I think today is going to be a case of whether it's turnaround Tuesday. We've had a sell-off on Thursday, sell-off on Friday, sell-off on Monday. Typically, that's a decent setup for a tactical bounce, but that's certainly not the message that futures are sending this morning. Instead, that break below the 50-day moving average seems to have given the bears a little bit of control, at least in the short term, and potentially you'd now be looking to support at 65.60 in the S&P. That is not only the low that we saw in September and in October as well, but we also have the 100-day moving average lurking in that region too. Having said that, over the medium term, I still think the path of least resistance leads to the upside. Zoom out on the charts. It's still been a very solid year. The S&P up 15%, the NASDAQ up almost 20%. So this is by no means me sitting here saying that Armageddon is on the horizon. And in fact, I think the bullish narrative remains a very convincing one. The underlying economy remains resilient. We've just moved through the fourth consecutive quarter of double-digit earnings growth for the S&P 500. The monetary policy backdrop is growing increasingly loose. I think market pricing, just a 40% chance of a 25 basis point December cut from the Fed is far too hawkish given the maths on the committee. And of course, we have a much calmer tone on trade continuing to prevail as well. So stocks taking a bit of a pause for breath, the market wobbling just a little bit, but I certainly would be in the mood to be buying dips if we were to get down towards that 100-day moving average in the S&P.